Trades right here on ET now, getting a little bit wobbly as we speak. In fact, we've come off a little bit from where we started off, which was much flatter a day. You are seeing that profit-taking play out in some of those railway-related trades, for instance. So IRFC is down about 5%. Similar is the price action for RVNL too. Dixon, of course, has taken quite a sharp knock, as was the case all through last week too. Another 4% gone for that stock. And then, of course, Hindustan Zinc, Angel One are some of the other names which are seeing some red ticks come by. Hindalco, Apollo Hospitals, Trent, HCL Technologies, BEL, and of course Adani Ports are some of the other names which are languishing in the red. Though on the flip side, Tata Consumer, Tata Steel, Asian Paints, Axis Bank and Nestle, they continue to be still holding out in the green. But let's welcome on board Lakshmikant Shukla as well and figure out what his take is on the markets. Lakshmikant, great to have you on the show. Just wanted to understand, when do you think we'll snap out of this range that we've been stuck in pretty much all through the year for the Nifty?
Good afternoon. The day when we started slipping lower with the formation of bearish candle, and for last 4 days, Nifty has been making lower tops and lower bottom formation. It generally faces resistance from the levels of 26,200, 26,100, and then after we have seen selling pressure in the market, and if it sustains well below the levels of 25,900, then we will see further correction toward the levels of 25,700. I think 25,700 would be the sacrosanct support for the Nifty. That would be the level which Nifty has been defended in previous sessions also. So I think if we see any reversal kind of formation near the zone of 25,700, so that would be area from where we can again go long and can expect the breakout on the upside. But for the time being, till it holds to the levels of 26,100, we expect that further decline could be possible toward the levels of 25,700 June.
Right, interesting. Okay, let's just pause for a bit and let's try and analyze the heavy supply, as multiple IPO lock-ins are going to be ending from this week, from December 29 to Jan 2nd. Over 50,000 crore rupees worth of shares could hit the street. Big names include Ventive Hospitality, Kalpatru, a massive HDB Financial Services unlock of about 36,600 crore rupees on Jan 2nd. Snehi, in fact, is here with all the details on the lock-ins which are opening up.
Well, yes, it's a heavy week of equity lock-ins that are coming out for some of the recently listed IPOs, as well as some of the IPOs that were listed a year and a half ago or even before that. So let's get right to it and start by talking about Ventive Hospitality. The 1-year share lock-in opens for that. About 52% equity or 12.2 crore shares will be out of lock-in. And if you calculate what that stake would come up to at the current market price today, this amount is worth 8,686 crore rupees. The 3-month lock-in for True Alt Bioenergy, Jinkushal Industries, Giant Resource and EPAC Prefab will be opening as well today. 3 to 4% equity coming out of lock-in for all of these names. Share between 14 lakh, 25 lakh, 1.2 crores and 37 lakh. In fact, Giant Resources has 1.2 crore shares coming out of lock-in. But because it's a penny stock, that stake value is not too high. But yes, 463 crore rupees for Giant Resources, 103 crore rupees worth of equity opening up for EPAC Prefab as well. So these are some of the counters to watch out. Next up, let's talk about the share lock-ins that are going to be opening tomorrow. Pace Digitech, the 3-month lock-in, about 3% shares of 56 lakh equity will be coming out, and the stake value is about 106 crore rupees. For Ellenberry Industry Gases, a 6-month lock-in is opening with 17% equity or roughly 2.3 crore shares that sum up to 802 or 800.3 crore rupees. That's the stake sale, that's stake value that's coming out of Ellenberry as well. Let's also understand for 31st December, the last day of this calendar year, recently listed Kalpataru Projects, the real estate company, a 6-month lock-in is going to be coming out, wherein 54% equity opens to be traded, 11 crore shares that stakes up to 3,704 crore rupees. So that's a significant chunk for Kalpataru Projects that's going to be opening. So day after tomorrow, we are going to be watching out for this stock very carefully. And along with that, you have an Acme Fintrade, where about 57 crore rupees of equity comes back to the market. For 1st of January, you have names like Glottis, an all-time plus plastics. For Glottis, it's 12.5 crores, and for all-time plastics, 105 crore rupee worth of equity will make its way back to the market. But more importantly, let's talk about the big names lined up on 2nd of January. It's HDB Financial Services. The 6-month lock-in for this IPO is going to be opening, wherein 58% equity, or a whole amount of 48 crore shares, is going to be out in the market, which laps up to 36,608 crore rupees. So that is going to be very significant in terms of how the stock could react to this lock-in opening. And we're going to be watching out for HDB Financial Services very closely on 2nd Jan, along with Allied Blenders. Slightly more than 1.5 year of lock-in is going to be opening for this stock. 20% equity, summing up to 5.6 crore shares, will be out of lock-in, and this comes to 3,363. Now, it's important to note that the quantum of the equity lock-in and the dates have been provided by Nuvama Alternative and Quantitative Research, while the stake value, we've multiplied by that by the current market price of some of these stocks today. So yes, these are going to be some important big names to watch out for, especially all eyes are going to be on HDB Financial Services on the 2nd of Jan.
Oh, yes, indeed. Quite a few of these lock-ins getting opened in just the next week alone. But just taking stock of what the market is holding up right now, and I just want to look at some of the gainers there. While, of course, we've been talking about NBCC, look at an NCC, for instance. That spiked up about almost 1.5%. There's SAIL, there's Cummins India, Sammaan Capital has perked up a good 2.5%. And HFCL is the one which is seeing the meteor moves today. It's a good 7.5% of an uptick coming in on that stock. But having said that, the breadth of the market hasn't improved. In fact, if nothing, it's only worsened from where it started off. And Kunal, to the point that you were making earlier today, that up until the breadth convincingly holds through, which as of now it's only intermittently, the market will not have that broad-based move, and the Nifty as well will not perk up further, because you won't have that confidence that the underlying breadth of the market is actually moving up meaningfully.
Yeah, absolutely yes, Aisha, because in the last I think few months we've seen that whenever the market breadth has disappointed, the index has actually gone into a bit of a trading range, or maybe we can call it as a consolidative band as such, with no major cues, no major trends emerging. Now, in the last 6-7 days also, I think we had seen a similar kind of a trend. We were almost at 25,750 mark just about start of the previous week, or the end of the week prior to that. And then from there, the market breadth started to look a little bit more better. We had 3 consecutive days where the net market breadth, that's advances minus declines, they were almost in the favor of 1,000, 1,300 kind of number. And in those kind of 3 days, the Nifty managed to climb back almost to 5,300 points. And then subsequently, when the market breadth became negative, the net market breadth, we saw the index going back into a consolidative band. So it clearly tells you one aspect, that the market breadth holds the key for the index to move up higher. Right now, we are also seeing that there's more of a sector churn which is playing across, and no major trends which is emerging. In fact, if you look at the month till date data, it's just the 2 broad sectors, the Nifty IT and the metal index, which have given positive returns and more strong returns. But then most of the other sectors have actually seen a lot of disappointment. So it tells you that the market breadth is still not very vibrant, and that's one of the major reasons why we are looking at this kind of a consolidative band. Now, something has to happen. Either you look at the events flow, that could probably be one of the reasons why the markets may try and come back into this trading range. The other data point could be the rise in India VIX. We've seen that slight jump in the India VIX from 9.1 to 9.6, 9.7 today. If we manage to come back to 10.5 mark or 11 range for the India VIX, that could also be a preemptive signal that we are looking at the index coming out of this grinding range.
Right, indeed. Okay, that's the India VIX, currently holding higher by almost about 6% as we speak. But Lakshmikant, what's your reading on both Nifty IT as well as metals, on how sustainable the move on both these sectors could be, and what stocks are looking good for a trade?
So Nifty IT has started facing correction after retesting its June month high near the levels of 39,500, and then after we have seen consistent formation of lower tops and lower bottom, and yesterday's sessions it slipped below its 20 SMA levels. So I think Nifty IT will we see further selling pressure in Nifty IT toward the levels of 37,900. But among the stocks, I think Wipro and SCL Tech where we are looking buying call, because Wipro has already surpassed its previous swing high, and we have seen consistent upside move in Wipro. So short term dip would be the good will give good opportunity for taking buy in Wipro toward the levels of 260 to 258 kind of range, from where we can go long and expect a pullback move toward the levels of 280 with the stop loss of 250 on the downside. So I think where we can go find good risk and reward ratio in Wipro.
Wipro. Kunal, give us a chart check on some of these buzzers like HFCL. If you track that on the charts, along with an HEG Limited, a 6 and a 7% uptick on both of these names. How are the charts shaping up?
Yeah, I think HEG and graphite is something which is looking extremely attractive. In fact, I do track these names, especially at the point when the market gets into that high beta zone, or the metal or the commodity sectors, they get into a breakout. We've actually seen HEG and graphite showing very good price momentum in earlier attempts whenever the stocks gathered momentum and managed to break past about their previous resistances. Right now also, I think they are just about inching very close towards a breakout of their strong resistance points. I think 600 approximately is the resistance for HEG, and closer to 640, 650 thereabouts for graphite. And I think both of these stocks are looking extremely attractive on the charts. In fact, we've seen for the first time that most of the monthly indicators are heading towards a breakout mode for these names. The RSI, for example, for HEG has managed to come back towards a multi-month high. That itself could be an indicator that we are looking at a point where many of these names, HEG, graphite and such other commodity related themes, I think they could do very well for themselves in the next 1 to 3 months.
Okay, those are some of the buzzing stocks in trade. Just looking at the losers list, and Lakshmika, want you to come in here with some of these railway names which are seeing a little bit of profit taking. I mean, most of these names have run up almost about 15 to 20% in just the week gone by. Right now, as you see it on the charts of IRFC and RVNL, and let's throw in Atitagarh as well over here, what's your reading? Could this profit taking last few more days?
See, in today's sessions, except I think Titagarh, both these IRFC and RVNL has witnessed profit booking from the higher levels. So I think further correction would be possible in IRFC and RVNL. So talking about IRFC, so it has made a piercing kind of pattern on the daily chart and started slipping below its 200 SMA. So further decline could be possible toward the levels of 129. And earlier it has seen the breakout from the same levels. So I think 120 will be the good level from one can go long in IRFC. And if we talk about the RVNL, so here we have also seen the same formation which we have witnessed in IRFC. So I think it is going to retest the 200 DMA, which is placed around the zone of 350. So I think one should wait if somebody want to go long in RVNL and IRFC. But if we talk about Titagarh, so Titagarh is still maintaining its positive structure, and we expect that this pullback ongoing momentum will continue in Titagarh. Immediate resistance is seen near the levels of 920 to 925, and if it surpasses this level, then further upside move could be possible in Titagarh toward the levels of 975 to 980 level. So within these three stocks, I think Titagarh is one of the stocks where we can recommend a long position with the stop loss of 890 on the downside, can expect upside move toward the levels of 950 to 960 kind of range.
Okay, so that's a chart check on some of...
Back with closing trades right here in ET Now, and we've got Ashi Anand joining in on the show right now to tell us about how the year ahead is going to look like. Ashi, hi, afternoon. Good to have you in ET Now. Ashi, I guess the whole debate is about whether or not small and mid caps will make a comeback come 2026. What's your opinion?
Yeah, sure. So actually, that is quite interesting. I think for small and mid caps to kind of come back, you first need the overall markets to come back. You need momentum in the economy and corporate earnings. I think so. That's actually the first kind of level. Now, that is something which I think people are hoping to start seeing from the current kind of quarter season itself. So as the kind of result season spans out, there are various different sectors where people are kind of watching for signs in terms of an earnings recovery. Now, depending on how the earnings recovery starts getting baked in, you should start to see an overall recovery in the markets. One other key element for markets to overall recover is some kind of clarity around what's happening on the US-India trade deal. Now, the way we kind of look at small and mid caps is you first need momentum of the overall economy, corporate earnings to come back, momentum back in the overall markets. And as you get confidence there, that is kind of when you start to see momentum in small and mid caps. I think expecting to see small and mid caps recovering without clarity around this overall corporate earnings recovery, that is probably unlikely. So we would kind of probably expect broader markets, the large caps to continue to kind of outperform broader markets probably over the next quarter or two. But as you get greater confidence on the earnings recovery is when small and mid caps should start to participate.
Okay, so that's the take on what the portfolio construct in terms of where the bias lies in terms of the large caps and the smaller and the mid cap end of the basket. So that's the take coming over there. Actually, overall, the market momentum, we've been absolutely lackluster and, struggling to hold around the 26,000 mark. Just in terms of momentum, do you believe 2026 could have a faster pace in the way the index changes in either direction? But do you think the pace that we're seeing in the market could quicken up next year?
So one, yes, we definitely hope so. And in fact, we're fairly confident that the momentum of the markets in 2026 would actually be kind of upwards. This is kind of driven by, it's to understand what has led to this kind of weakness in 2025. You've kind of come off a couple of years of very strong market performance, and the economy was firing, corporate earnings was very strong. There weren't any uncertainties or around at least the US-India kind of trade. These uncertainties were not there. Now, what you have kind of really been battling through most of 2025 is a slowdown both in economic growth as well as corporate earnings. Now, as that has kind of slowed down, given the fact that markets had already moved up quite substantially, there was a need for for the markets to take a breather, and that's what you've effectively seen through 2025. You are starting to see initial signs of the economy starting to turn around. There have been various measures that have been put in place over the last 6 to 9 months. It would have started from income tax cuts in the lower tax slabs, GST rationalization, the cut in interest rates. All of these kind of come together to kind of lay a fairly strong foundation for consumption to come back. You also have kind of the banking sector, which has been impacted by NIM pressure, by asset quality pains. A lot of these seem to have bottomed out. So as you're kind of getting into 2026, there are clear signs of parts of the market which were under strain starting to kind of come back.
We've got Ashi on a patchy line, but just addressing the flash that we were seeing on the bottom of the screen right now, it's Fusion Finance. The fundraising announcement has come along the lines where we were expecting to see the board has approved an issuance of 2,000 crores via debt, so that's via non-convertible debentures. And this also includes a green shoe option of 50 crore rupees. Let's pull up the stock, a little spike. We'll give that news some time to settle for the stock. But Kunal, any view on Fusion Finance right now? 158 is where the stock is at.
I don't track anything else.
Okay, no worries. So that's the news that we're getting on Fusion Finance. But Kunal, earlier in the show, we were talking about Honasa Consumer and the block deal that we've seen on the show, 18.5 lakh shares changing hands of Honasa Consumer. And in fact, as we speak, there's a block deal on ITC. It's a massive one. 4.5 crore shares have traded hands in ITC. Kunal, a quick chat check on both these names, Honasa and ITC.
Yeah, so I think both of these stocks are still struggling. Honasa, for example, at 270 to 72 where it's trading right now. There is in fact, a bearish crossover, where the 50 DMA is about to cross over on the downside, the 200 moving average. That I believe could probably act as more of a corrective phase for the stock. So even if the stock has bounced back from the recent lows of 250 thereabouts towards 270 plus where it's trading right now, but I believe that with the pressure of this bearish crossover, the stock may go into a retest of the previous lows around the 250 to 55 mark. ITC on the other hand, in fact, we are starting to see some respite coming back into many of these FMCG names, and FMCG as an overall index has underperformed in the last many months of this market move, where we've seen underperforming sectors trying to make a comeback, but FMCG stocks have not made a comeback for themselves. But there seems to be some bit of sign where many of these FMCG names are seeing price volume action. ITC I think could be a case in point over there. The stock is still trading around just around that 400 levels broadly. So I believe that if the FMCG index manages to pick up, then I believe ITC can also try and come back towards the midpoint of the trading range, which could be around 420 to 450 mark for the stock.
Okay, that's that on ITC, seeing a sizable block deal over there. But in the meantime, let's also take stock of what's happening in IRFC. And it's been in focus after it was provided a 9,821 crore rupee loan to the Dedicated Freight Corridor Corporation of India to refinance its debt taken from the World Bank. Now, earlier we spoke with Manoj Kumar Dubey, the CEO and CMD at IRFC, and here's what he had to tell us.
Rupee sliding and dollars getting dearer, these loans were getting very costlier for them. So we pitched in, and this is one of its very unique kind of deal where every stakeholder was very happy. World Bank was very happy getting it refinanced through us so that they can use this money to other projects in the country. And as DFCCIL has already come out with the information that they will be saving in tune of around 2,700 crores throughout the tenure of the loans. And at IRFC, this is a disbursement that we have done the very same day when the agreement was signed. And this is going to give us a lot of impetus in terms of our NIM, AUM, as well as the margins. Guidance right in the beginning of the FY for around 30,000 crore of disbursement and around 60,000 crore of signing of the agreements and sanction of the projects. We are well on the course. You have seen our Q2 results up to H1, I believe. And when we are closing on our Q3, the way things are going on, the way we have already informed the exchanges, we are nearing completing our target of sanctioning of the estimates and signing of the agreements. And on disbursement also on pro rata basis, we should be completing or going ahead of the 3-quarter targets.
Ashi, you've been tracking this space very closely. Give us a sense of what effect are you expecting to see on your portfolio of the existing quick commerce giants once Zepto also formally lists. So what's the impact that you're expecting on the existing players in terms of their financials, operations, and most importantly, their market share?
Sure. So the Zepto IPO is definitely going to be very interesting and very closely watched. I think firstly, in terms of our own portfolio, we will be monitoring it quite closely to kind of understand as more details come out as they get closer to the IPO. In terms of just understanding what are the valuations that's going to be coming in. It is very, very interesting because unlike an Eternal or a Swiggy, where you have two businesses, food delivery and quick commerce, a quick commerce at this point in time clearly seems a faster growing business. However, food delivery is a business which has matured a lot more, and I think competitive dynamics are a lot clearer in terms of who the eventual winners are. So in terms of, I think, interest in Zepto as a company, it is going to be fairly high, and we're going to be evaluating it quite closely. And I think without any doubt, quick commerce is possibly the most interesting land grab or the most interesting kind of sector which is out there currently. You have the sheer amount of kind of traditional commerce and e-commerce that has the potential to move towards quick commerce. The overall opportunity size is so large that we believe that over the next year or 2 years, you're still going to be in a fairly highly competitive environment. Now, obviously, Zepto going out and raising funds does actually give them the firepower to kind of continue to be aggressive in terms of competition. Both Eternal and Swiggy have decent amount of cash on their balance sheets. And you also have kind of the Amazons and the Flipkarts and various other players also coming in. Our view on quick commerce is that this place is going to be very competitive in the near term. We, unlike other market participants who kind of focus in terms of how quickly our losses will bottom out, we think it is more important that companies continue to invest, continue to kind of grow even at the cost of short-term profitability, because it is very important to ensure that you're one of the top 2 or 3 winners in the space 5-6 years down the line. So now within all of that kind of, I think Zepto, Swiggy, Eternal, all of these companies have a clear right to win in quick commerce. All of these are interesting opportunities. In terms of our own portfolio positioning, it'll really be a question of the relative valuations. And Zepto, a lot of numbers aren't yet out. As some of those numbers come in, it'll be a bit clearer.
Interesting. Kunal, how are the charts of Zomato as well as Swiggy stacked up?
See, I believe at current levels, 285 thereabouts for Eternal, I think it's a good zone where the stock seems to have consolidated. It's come back towards the longer term moving averages. The major correction which started off at around 360 odd mark from those levels for Eternal. So that 20% odd correction is now behind. We're looking at the stock just about grinding through a more of a range over here at the 280 odd levels. And I think at current juncture, I would believe that the risk reward is extremely positive for investors as well as longer term traders to go for a buy. Swiggy, on the other hand, the stock had a bit of a momentum as well as a volume push. I think a couple of weeks back when the stock moved past closer to that 410, 420 levels. But again, with the stock coming back to that 400ish kind of a zone, indicates that this range is more of a consolidative range for Swiggy. So would not be bullish on the stock at current levels, but yeah, I think about 420 levels is where I would expect a breakout. But for Eternal, I think at 280 levels, there seems to be a very strong evidence that indicators are entering into an oversold territory. So the risk reward is positive to enter the stock at current zone.
And is that the view you have for Nykaa as well on the charts, Kunal? A 60% uptick on a year-to-date basis. More legs to that rally?
Absolutely, yes. In fact, 4 consecutive quarters for the stock from 150 to 250 to 75, just closer to that 270 levels when Nykaa had hit that kind of a zone. The daily as well as the weekly indicators were into a overbought territory, and then you saw the stock cooling off a little bit, trying to go into a consolidation. Maybe over the next 1 or 2 months, you might expect that the stock may just about hang around to this 250 range plus minus 10 odd points for the stock. But then the trend which has started off 4 quarters back for Nykaa from those 150 levels indicates that we are looking at this as a multi-year uptrend for the stock.
Okay, that's 258, and that's where Nykaa is currently in trade. Actually, where amidst the entire pool of the new age tech companies are you finding favorites? And let's keep the QCOM and food delivery names outside of the list. We just discussed those.
Yeah, sure. So actually, firstly, we kind of like the overall space. And I think the view is that you are seeing a big value migration away from traditional commerce towards new age digital kind of commerce. Now, within that, there are obviously multiple pockets. And the way we like to look at a fund is that we actually buying the fastest growing companies in a fairly wide range of different sectors. So obviously, food delivery and quick commerce, which you've discussed, is very attractive. But the second space, which is extremely kind of large, and we see a lot of value being created there, is the overall fintech / wealth tech space. So someone like Paytm, someone like Policy Bazaar, various other new companies that are expected to be listed. There is a very large potential for kind of delivery of financial services towards segments of the population that were previously kind of unbanked or under kind of service from traditional finance firms. And new age digital platforms really make service delivery significantly easier. We see a lot of kind of optionality on some of these platforms. Companies like a Paytm, which has traditionally been a payments business, you'll actually see it kind of morph into a much larger financial services firm. And you see this for other kind of companies as well. So I think fintech, wealth tech is something which clearly is very interesting. The other segment is kind of, horizontal commerce. We've just discussed Nykaa now. I think Nykaa is a great example of this overall trend that we're talking about. Consumption has been weak, and consumption has been weak for the last year and a half. But if you look at Nykaa's numbers, they've consistently been growing. And that is reflective of the fact that not just is BPC as a segment fairly attractive, but the sheer shift that is happening away from traditional forms of consumption towards online. So both kind of vertical commerce as well as kind of other e-commerce plays, Meesho has recently gotten listed. That also is kind of fairly interesting. So we kind of see interesting spaces there. There are some interesting smaller bets, online gaming in India potentially has a very long way to kind of play through. There are certain other interesting niche opportunities in B2B classifieds, various forms of classifieds, etc. So there are multiple different segments. All of them are looking quite attractive. What we tend to focus the most on is which are the segments where you have the clearest right to wins having been determined, where you can predict with a fairly high degree of certainty, 6, 7, 8 years down the line, what the kind of market and competitive environment is likely to look like, who are going to be the winners, and what is the monetization capability. And I think within that framework, it's really kind of quick commerce, food delivery, vertical and horizontal commerce, and kind of the fintech. These are the spaces that we find the most attractive.
A bunch of names you've mentioned over there, Ashi. Kunal, a chart check on Paytm. It's done well, no doubt, but it's still about 16 to 17% lower from its IPO listing price. More run up only because of the fact that it's still not reached its IPO price, or do you believe that the rally that we've seen this year is good enough?
No, so I think I'll compare Paytm not just in terms of price, but in terms of the behavior. Because it's very, very essential to track that, because from those, I think 2000 odd levels or 1800 levels, which was the high for Paytm, I think from that kind of a zone, there was a point where when Paytm went to 450, 470 thereabouts, the stock was an extremely high beta name. Now you look at the last and in various market moves, when the indices used to move up higher, the stock used to participate in a much more high beta fashion, and then vice versa, when the markets used to go into a correction, the stock corrected far higher than the indices. But the last 6 months, 1 year broadly, we've seen a big change happening for this beta nature for the stock price. Now that essentially tells us that we are looking at a new trend emerging for Paytm, something which could be completely different than what it was maybe post the listing for the stock in 2021-22 odd period. So I think in that sense, yes, there should be more up move for Paytm. The fact that the stock is not very high beta, goes into a sideways range when the markets go into a phase of a correction, or when the sentiment becomes a little negative for the overall markets. And then when the markets manage to pick up pace, you see the stock getting back into a breakout. So that I think is an ideal quality for a stock which continues to, I would say, share positivity over the medium to long term. So bullish on Paytm at current levels, and in fact, in case if there is any kind of a mild consolidation, say a 5% to 10% kind of a drift into the stock price, that should be taken as an opportunity to average.
Okay, that's that on Paytm right now. The Nifty, of course, has slipped below the 26K mark. Let's see where we actually close the day. And the breadth, of course, has gotten a whole lot worse. 165 is the count to the red, with just about 48 to the green within the F&O universe. But actually, for the year ahead, what should be the right asset allocation mix? I know it's, literally person to person, and everyone would have a different, case and a cause. But largely, what would you recommend between small caps, large caps, silver, gold, realty, etc., and fixed income, of course?
Okay, sure. So that's actually, it's quite a wide question, right? So I think firstly, just sticking to equities, in the near term, we continue to kind of favor larger mid caps over kind of small caps. We believe you need much larger kind of economic and corporate earnings momentum before you start to see small caps starting to kind of participate. It's also important to understand that small caps have had a couple of very, very strong years, and arguably kind of valuations are a little more comfortable in large and larger mid caps as compared to smaller caps. So within kind of equities, at least in the near term, we would continue to favor large and mid caps. Our view is that equities should start to see a rebound going into the next year. So equity over kind of fixed income quite clearly. That said, this is obviously kind of, these are just larger calls. It will vary individual to individual in terms of what their specific requirements are. But as long as there is a longer term investment horizon where volatility of markets can be is not an issue, I think we clearly would recommend equities over kind of fixed income. Now, kind of the whole outlook on precious metals is really quite challenging. These are kind of difficult to it's very difficult to kind of model what's going to happen in precious metal prices in the near term, because there is no fundamental basis in which these can be valued. I think the one element to note is that these have had a very, very sharp run up, and what tend to be classical signs of coming close to the top of a bull cycle, where you have many, many retail investors starting to kind of jump in after a significant move has happened. You're seeing that kind of quite clearly. We would be quite cautious about precious metals. I think a large part of the run up has happened when you're actually now buying after the fact. So that is something we'd be a bit cautious about. Real estate, we are kind of positive longer term. We believe that pricing momentum should kind of be there. But a large part of the kind of pricing catch up that had to happen, it is important to understand 2010 to 2020, really nothing much happened in terms of real estate. So you've had a couple of years of fairly strong price improvements. We believe you're not likely to see price gains of that magnitude, but general positive sentiment around real estate prices should kind of sustain in our view. So broadly, if I had to kind of rank these, it would really be equity quite clearly up there, fixed income for people who have shorter term requirements and where there is a need to kind of protect capital, followed by kind of real estate, and then lastly, precious metals.
Okay, that's the take right now coming in on, what kind of asset allocation one should have. In the meantime, some important news flow that we've been awaiting out on your screens right now. And, in the most recent announcement, the Defense Acquisition Council, or the DAC, in their session that just concluded, it has, decided or rather approved the extension of emergency procurement framework until January 15, 2026. Now, this also is going to be allowing a lot of companies to participate. Having said that, they've also talked about some deferred mega deals as well. There are some proposals which are under the final review, and they were rather expected to consider approximately about 80,000 crore rupees in major procurement proposals today. So I'm just waiting for our reporter to join in because this is what the market was actually focusing in on as to what exactly happened about this 80,000 crore rupees of procurements which was on the table to be discussed. Any details coming in on that?
Yeah, we have a bunch of equipment that has been specified so far. The loiter munition system for the artillery regiments. This is the procurement green flag coming in. Low-level lightweight radars, long-range guided rocket ammunition, and the Pinaka multiple launch rocket system, along with a couple of aerial devices, drones, as well as some of the combat aircraft, Tejas aircraft that we're expecting to see. So yes, these are some of the names that have been out in this circular. But for more details, let's take it across to my colleague Prakash, who's been covering this and is here with all the details from the ground. Prakash.
Yeah, that's an important development coming in as the Defense Acquisition Council, chaired by the Defense Minister, Mr. Rajnath Singh, has cleared proposals worth rupees 79,000 crore to enhance the capabilities of the armed forces. A very significant development coming in. In fact, the proposal has been approved for the procurement of loiter munition system for artillery regiments, low-level lightweight radars, long-range guided rocket ammunition for Pinaki multiple rocket, launch rocket system, and integrated drone detection and system for MK2. So these are the important development for the Indian Army, where significant proposals have been approved by the Defense Acquisition Council. As far as Indian Navy is concerned, several such proposals have been approved by the DSC, where high-frequency software-defined radios, leasing high-altitude, long-range, remotely piloted aircraft system, induction of BP tugs will, and these equipments and limitation, of course, these equipments and weapons will support the Indian Army to improve its capabilities going forward. As far as Indian Air Force is concerned, significant such proposals have been approved, such as automatic takeoff landing recording system, Astra MK2 missile, full mission simulator, and SPICE 1000 long-range guidance kits. So these are the key proposals which were approved by the Defense Acquisition Council, chaired by the Defense Minister. In fact, that's going to provide some significant boost to the domestic defense manufacturers, manufacturing companies, as these all procurement will be done through domestic defense procurement schemes. So these are a very significant development coming in. 90% of the weapons and the proposals which have been cleared today will be procured through domestic defense manufacturers. These are key development coming in, and of course, domestic defense manufacturing companies are going to get big proposals going forward.
Yeah, absolutely. Let's discuss that point further. It's, of course, a sizable approval which has come in to the tune of 79,000 crore rupees. Although, to be fair, the market was already working with that 80,000 odd crore rupee number, and most of these stocks had already run up in anticipation of this actually going through. But we've got Harshit Kapadia on the show with us today. Harshit, hi, afternoon. How do you think this proposed 79,000 crore rupees in approvals affect the current order books of lead integrators, the likes of Bharat Electronics, Bharat Dynamics, etc.?
Yeah, hi, afternoon. So definitely it will boost the order inflow potential for some of the companies which you already mentioned, some of the even private sector companies who are expected to get this order. But this is just a proposal which has been accepted. It generally takes around 18 months to 2 years for proposal to convert into order inflow for most of the names which will be getting the orders. But yes, you have both private as well as public sector will be beneficiary for this 79,000 crores.
And Harshit, how does the 79,000 crore figure play into India's existing defense capex? And you shared with us the timeline. So would it be fair to understand that the near-term force readiness that we require for our Navy, Army and Air Force, that's going to take some time from now?
Yes. So for the short-term part of it, I think there's already been an emergency procurement segment 5 which has been ordered out. Some are also right now under ordering stage where the proposal was 40,000 crores. So this is over and above that 79,000 crores which they have approved. So that's how we look at it.
Okay. And Harshit, how much of the 79,000 crore DAC approval is likely to translate into executable orders in, let's say, FY27, FY28? And who do you think the biggest beneficiaries here could be?
I think as far as FY27 is concerned, maybe some small size orders which can get converted into order like full mission simulators for light combat, aircraft stagers, etc. So smaller systems can get converted, but our larger systems like Pinaka rocket, oil ordering munitions, which they have ordered out, that will at least take more than 18 months time frame to get converted into order inflow, which will take FY28 time frame. The major beneficiary that we understand is Bharat Electronics within this frame for the solar industries, Bharat Dynamics. These are the three major players who will get benefit of the 79,000 crore capex.
Harshit, now with the implementation or rather, effective implementation of the DPM, how will the 25% procurement reservation for MSMEs and the removal of bid security requirements specifically benefit, say, defense startups like a Zen Technologies or a Data Pattern in this latest round?
So if you look at, as far as MSMEs are concerned, there has been PSU has been buying a lot of the components from them, and recently there have been 5 lists which each of the PSUs have released, where they want to increase their procurement from MSMEs. So it will definitely see a lot of startups which are trying to get into this defense ecosystem will see a bigger boost. As the idea of the government is that PSUs would be a lead integrators, and these small and mid-cap private defense companies would be the component suppliers to this integrator system. So there is a huge inflow which you will see more coming to private sector than to the PSUs.
So similarly, what about private giants like an L&T or a Tata Advanced Systems participating in complex projects? Do you think that's also likely, that integration?
Yes. So if you look at the defense ecosystem is now broken down into 3 segments. One is defense PSUs, which will be larger integrators of very critical system. There is a large defense private sector, with some of which you already mentioned names, L&T, Tata, Adani, who will be a lead integrator for some of the modern kind of missiles, which are also critical and where we have technology deficits. So some of them can do a collaborative work with some global giant and can bring those technologies here through this integration mode. And third is the small and mid-cap private defense companies who would be the support system for the entire 2 large ecosystem of private and public PSUs. That's how we look at the defense ecosystem to build it.
Okay, and Harshit, talk to us about what impact this DAC nod could have on indigenized weapon production, or is it going to be done in tie-ups with OEMs? And also the bigger picture, what could this do to India's defense exports?
So as far as defense ecosystem is concerned, so what will happen is, 90% of this 80,000 crores is what is being looked through indigenization sources. So we will see a lot of design and development activities from both PSUs as well as private sector. So Bharat Electronics, being one of the lead, integrators and designer of a lot of these systems, will see a primary beneficiary. It will then rotate down to companies like Data Patterns, Astra Microwave, unlisted companies like Ananda Technologies, Apollo Microsystem, etc., will be a secondary benefit of these ecosystem play. As far as exports are concerned, right now we are looking at exports in terms of missiles. That's our first, segment that we are looking at. But after that, we are looking at even helicopters and aircraft as well. So that's still in the fray, but nothing conclusive has come till date.
And I guess, Harshit, this would also sort of change the investment outlook for firms which are specializing in, maintenance, repair, overhaul as well. Although it's a very long gestation outlook, but still, the market would want to re-rate these companies too, right?
Absolutely. So if you look at the entire budget, major part of the budget gets into spares and the other equipment, which is the larger form of the defense capex which goes to. So as more indigenization happens, we have to do more MROs here. A lot of foreign collaborations are also happening. So we are trying to understand, how the spares and ecosystem will work here. So that is another area of sustained growth which we will see, but over a longer term time frame.
Okay, Harshit, thanks so much for joining in with that quick take. Great to get your insight as always. Okay, we've done for the day, and it's the last trading week of the calendar year. We've closed in off from the day's highs, although the day started off itself on a very quiet note. We've knocked off about 100 odd points, and the breadth of the market as well hugely opened up in favor of the declines. But Kunal, what does it tell you about where the markets are going to head next?
They're heading nowhere.
Nowhere,
I think the last 3 months have been very sideways. It looks like that maybe the markets are waiting for the December expiry to end, and I think we should just about hang around to that 26,000 mark. So unless there is a major change which happens across the global markets up front, I would believe that the indices over here for the next couple of days, I think should just about consolidate.
Okay, so that's the take on the market, and in fact where we are heading, Kunal says that's absolutely nowhere, where we've shut shop under that 25,950 mark. So let's see what tomorrow holds on for us. It's the monthly Nifty expiry, so we are going to be bracing ourselves for that. But with that, it's a wrap on this edition of Closing Trades. Thanks so much for tuning in.